All right, today we're diving into what is pretty much considered the Bible of investing. Here's the thing, it came out way back in 1949, but I'd argue its lessons are more critical today than ever before. This is Benjamin Graham's masterpiece, The Intelligent Investor.
And hey, don't just take my word for it. I mean, when Warren Buffett, arguably the most successful investor of all time, and Graham's own student calls it by far the best book on investing ever written, you kind of have to pay attention, right? This isn't just a book, it's the foundation for a philosophy that literally created legends.
So where does Graham even begin? Well, he gets right to the heart of the matter, tackling the single biggest challenge every investor faces, which is the sheer irrationality of the market. And he does it with this brilliant, simple little story.
He wants us to meet a guy named Mr. Market. Imagine you're in business with this person, and every single day, your partner, Mr. Market, comes to you with the price. Now, some days, he is just euphoric, over the moon, and he'll offer to buy your shares for way more than they're worth. But then on other days, he's in a full-blown panic, terrified, and he'll offer to sell you his shares for almost nothing. He's emotional, he's unpredictable, he's a total mess.
And right there, that's the core of it. Graham lays out a choice for you. You can either treat Mr. Market as your servant, you use his bad moods to buy things on sale and his great moods to sell things for a premium. Or you can let him be your master. And if you let him become your master, well, his panic becomes your panic, his euphoria becomes your euphoria, and that, my friends, is a surefire way to wreck your portfolio.
So how do you protect yourself from this guy, Mr. Market? Well, Graham's first step is drawing a really sharp line in the sand. He separates two things that, honestly, most people get totally mixed up.
So, according to Graham, for something to be a real investment, it has to pass a three-point test, no exceptions. 1, you have to do your homework, thoroughly. 2, you have to make sure you won't lose your shirt. And 3, you're looking for a satisfactory return, not a lottery ticket. Look, this isn't about swinging for the fences and hitting grand slams. It's about getting on base consistently and reliably.
And this is so important to his whole philosophy. If what you're doing doesn't check all three of those boxes, you're not investing, you're speculating. Now, Graham wasn't saying you can never speculate, but he was crystal clear. If you start confusing speculation with investing, you're setting yourself up for a world of hurt.
Okay, so once you understand that line between investing and speculating, it leads you straight to Graham's most famous, most powerful idea of all. The one tool you need to manage risk and really succeed in the long run. So if you had to boil down this entire book, this entire philosophy, into one single powerful rule, what would it be? What's the one thing that holds it all together?
It's this, the margin of safety. That's it. Graham had this brilliant analogy. He said, think about building a bridge. If you know that bridge needs to hold 10,000 pounds, you don't build it to hold 10,001. No, you build it to hold 30,000 pounds. That huge gap, that buffer, that is your margin of safety.
So what does this actually look like with stocks? Well, let's say you've done your homework and you figure a business is worth about $100 a share. You don't buy it at 95. You don't buy it at 80. No. You wait. You wait for Mr. Market to have one of his bad days, and you buy it when he's offering it for, say, 60 bucks. That $40 difference, that's your margin of safety. It's your buffer, your protection.
And this is why it's just pure genius. See, it's not just about getting a bargain. It's about being humble. It's admitting that you don't know everything, that the future is unpredictable, and that, hey, you are absolutely going to be wrong sometimes. Your analysis might be off, bad luck might strike. A big margin of safety means you can get things wrong and still come out ahead.
So, okay, this all sounds great in theory, but how do you actually do it? Well, Graham was a total realist. He knew that not everyone is going to quit their day job to become a full-time stock analyst, so he laid out two very different paths you can take.
First up, you've got the defensive investor. Their main goal, don't make any huge mistakes. Just aim for a solid, adequate return without having to spend all your weekends buried in financial reports. Then, you have the enterprising investor. This is the person who's willing to put in the time, do the deep research, and really try to beat the market averages. And here's the key takeaway he hammers home. This choice has nothing to do with how smart you are. It's all about how much time and effort you're genuinely willing to commit.
And man, Graham gives a huge warning here, and you really got to listen to this. He basically says that trying to be an enterprising investor but only doing it half-heartedly is the absolute worst thing you can do. You'll likely get worse results than if you just stuck to a simple defensive strategy from the get-go. You have to be brutally honest with yourself about your commitment level.
And that really brings us to the final, most important lesson of the whole book. the real heart of the title. See, when Graham talks about an intelligent investor, he's not talking about your IQ score. He's talking about your temperament, your character. You could be a certified genius, but if you don't have the emotional discipline to tell Mr. Market to get lost and to always demand a margin of safety, you are going to fail. Because at the end of the day, the battle isn't you against the market, it's you against yourself. And that's the real challenge, isn't it? Is your discipline stronger than your intelligence?